Hi, I'm Rusty Dornan from the Kaufman Fellows Academy, and here today to welcome our honored guest for the day, Alan Chiu. He's a partner at XSeed Capital, but I do want you all to know he's not just a big bad VC. He's also vice president of the Stanford Angels Entrepreneurs, and he really helps foster relationships among entrepreneurs and investors in startup communities. So welcome, Alan. We're going to jump right into the first question today. You're a partner at a VC firm. First and foremost on people's minds is, how do entrepreneurs gain the attention of a partner at a VC firm?
The best way would be to get a warm introduction from someone the partner knows and trusts. It sounds cliquey, but the reality is we get a lot of inbound interest, and there has to be some way for us to filter through the incoming requests. And from experience, prioritizing inbound interests or requests for meetings based on who referred the person to us has been one of the most effective ways to do that. And of course, once you've gotten an intro, you want to have a tight story together through an email in one paragraph, summarizing the opportunity you're attacking, why you're the best, how are you different, to catch the partner's attention and pave the way for a productive phone call or face-to-face meeting.
So, Alan, should you stack or attach anything else to that email, or do you just keep it tight, keep it intriguing to get your attention, or do you put anything else in there? Do you just wait?
Different investors would have different preferences. For us, most of the time, a one paragraph summary of what you're doing and the business you're trying to build and why it's a compelling opportunity for venture investors to pay attention to will be sufficient to catch our attention. And following that, we would typically arrange for a phone call or face-to-face meeting to learn more about the opportunity. And as preparation leading up to that, you may or may not want to send us a pitch deck. We don't really care one way or the other. Some entrepreneurs prefer to just have a conversation and talk through their business. And it works for some people, but doesn't work for all people. If you're an entrepreneur trying to take that approach, what you want to think through in your mind is, how good are you in leading an investor you're meeting for the first time through your story, and making sure that in that process you're covering all the key points of your business. Because from an investor's point of view, we don't really care how you communicate information to us. We're all looking for essentially the same information. What's the opportunity? What's the problem? What's the solution? Who are you? Why are you doing it? Etc. Etc. What we have seen is some entrepreneurs, they start off with a conversation and then it just goes all over the place, and in the end we walk away and still don't really understand, okay, what makes this opportunity so compelling. Mm-hmm. Right? So that's when. So if you're not good at leading a conversation like that, then use a pitch deck. There's nothing wrong with it, and use that to help you structure the conversation and as a prop to pull the conversation back to what you want to talk about.
Okay, I do notice we have some viewers, and I would urge you to ask questions of Alan Chiu, who's a partner at XSeed Capital here in Silicon Valley. Let's go back just a little bit, though, to that warm introduction. I like the way you phrased that, warm introduction. All right, so people are getting emails, or you're getting emails all the time, that sort of thing, and you're looking for, in that first line, are you looking for it in the subject line, who the referral is from? Is someone else going through your email to kind of go through it and harvest through it? Describe, what's that best way to catch somebody's attention in that? Is it in that subject line with the referral?
In the subject line, what I need is a few words describing what the business is. Right? I know who the email is coming from, and so just let me know this is an intro about a certain business, and include a company name in the subject line. That would be sufficient. And then in the body, describe your business in one paragraph. I've received emails that consist of multiple paragraphs, almost like an essay on the business, and that's way too long, right? Just summarize what you're doing in one paragraph. And most, even in some of the largest businesses on the planet, could be summarized in one paragraph. In
the news business, we used to call it the radio version, because the radio version is 30 seconds. So give you the radio version, right? You're talking about, that long introductions kind of turn you off and everything. What about, is there anything else in an initial executive summary that, kind of turns you off right away?
Um, Initial executive summaries that turn me off would be ones that demonstrate a lack of understanding of the market or the competitive landscape that the entrepreneur is in. That, I mean, that's really a reflection of the lack of understanding of the entrepreneurs in for the opportunity and the market. So I'm not sure if even if they don't show that through an executive summary, I guess that would come out in the face-to-face. But I have seen executive summaries that haven't been well researched or well vetted, or the entrepreneur hasn't really thought through the product strategy or the go-to-market strategy, and that comes through. And when I see that, then even if it comes through a warm intro, that would it reflects poorly on the entrepreneur. So if you were going to send something, make sure that it's well thought out. Make sure that it's been vetted, because everything you do, everything you say is, think of it as an interview, right? Or dating. Everything you do, everything you say is going to be used as part of the evaluation of how compelling the entrepreneur is and how compelling the business is.
What kind of backgrounds? Let's say you have the person's describing their team. They've gone past that first email and they're describing their team. What kind of founding teams are you looking for? What kind of balance do you like to see?
Ideally, we'd like to see a founding team that covers 3 areas. 1, someone who could build a product. 2, someone who knows what goes into the product and what gets left out of the product. And 3, someone who could get customers. These are the 3 essential functions of getting a business off the ground. So within the founding team, be it 2 people, 3 people, you want to make sure that the collective skill sets and experience cover all 3 bases. We're also looking for what I would call founder opportunity fit. I'm looking for something in the founder's background or interest or knowledge that maps well to the opportunity, that convinces us that this background, this unique makeup of the founders gives them an unfair advantage and gives them unique or non-obvious insights to attacking this problem.
Once your firm has decided to invest, what is the average time in negotiating a term sheet? Is there one?
I would say from first meeting to signing a term sheet, on average, it takes 1 to 2 months. The process goes like this. The initial meeting usually is with one of the members on our investment team, and we are a boutique firm. There are only 5 people on the investment team, so it's not as if you need to go through multiple rounds. So after the first, on a lot of rounds, after the first meeting for vetting the opportunity, if we decide to go ahead and think there's a potentially an investment opportunity there, then we'll invite the entrepreneur back to meet with the rest of the team, the whole partnership. And then following that, if we still want to go ahead, then we'll go into diligence mode, which mainly consists of talking with customers, if there are any, and talking to people who have worked with the entrepreneurs in the past to get a better feel for what they're like to work with and whether the styles are going to be compatible with our firm's culture. And the last step would be a meeting with our investment committee, where we officially make the decision to whether to present a term sheet and under what terms. Usually the decision will have been made by that time. The investment committee is really the last gate to make sure that we have covered all the key areas that we want to ask about. When it comes to the actual term sheets, there are not a lot of, there might be a lot of terms on first blush, especially if this is the first term sheet that you've ever received. But the terms that matter, there are only a handful of them. So it doesn't usually take that long to come to terms on what those key items are.
Let's talk about those key items.
Sure.
Jason and Brad go through them, but in your opinion, what's the number 1, what's number 2, that kind of thing?
Naturally, most entrepreneurs would care most about the valuation, and we are seed stage venture investors, and at this stage there's really little to no revenue to base a valuation on, so it's completely market driven. We see a lot of deals, obviously, and we are very actively investing in companies. So we have a lot of usually more market data than the entrepreneurs. But fortunately, the ecosystem has become more transparent in the past few years. So there's a lot of market data that the entrepreneurs could get access to by talking to other entrepreneurs, by and going online and doing some research. So the valuation is completely market driven. In terms of the actual instrument of investment, we are seeing increasingly seed stage institutional investors moving away from doing convertible notes and doing price round or equity rounds. Angels are still by and large doing convertible note investments. For XSeed, we have a strong preference for doing equity rounds, and we could go further into that to explain why. Going back to the terms that matter, other than valuation, it will be the board composition, liquidation preferences, and the board composition.
Okay, and we'll go through those in a minute. We did get a question. We'll go ahead and go to the question, then we can come back to some of the terms in the term sheet. We have a question. What is your criteria when investing? We know the popular criteria. I am more interested about your emotions when you decide for an investment. Your gut.
So for XSeed, we have strong preference for companies that are building the products based on compelling technology that it would be difficult for the competitors to replicate, because our belief is if you are building a product of differentiating technologies, that gives you more time to build a moat around your business. So you have a higher probability of success. And if you're able to build a strong economic moat around your business, that gives you pricing power, which leads to a higher return for our investment. In terms of emotions, that really a lot of that comes down to our interactions with the entrepreneur. What would turn us off would be an entrepreneur who's arrogant or who seems out of touch with market realities, be it on the fundraising side or with the target market they're trying to sell into. What also turns us off would be entrepreneurs who oversell the traction that they have. That's a real turnoff, because it's something that you can't really fake. It is easily diligenced, so might as well be upfront and honest about what you have accomplished, the kinds of customers you have, how many revenue level. I'm not saying that you just talk about what you have done. You should definitely talk about the future, your vision, your hypotheses. Why do you think this is worth investing your life and other people's lives and capital into it? But be realistic, be honest. And at XSeed, everyone on the investment team has been an operator before. I've worked at 3 different enterprise IT startups. Some have succeeded, some have failed. So we know what it's like. We know it's hard to build a startup. Just be honest. And lastly, we're looking for entrepreneurs who are coachable. It doesn't mean they follow everything the investors tell them to do, but we're looking for entrepreneurs who are intellectually honest, right? Who are open to feedback that's different from what they had wanted to do. And sometimes they might choose to follow the advice, sometimes not. But we're looking for someone who could engage in that kind of dialogue to get to the best outcome. As one of my partners likes to say, we're looking for people who are interested in getting it right, not being right.
Mm-hmm. We have a couple more questions here, and I'm not sure if he means overall or for your firm. What is the average success rate of investing?
Which is it's typical of the venture industry. I would say 10 to 20% would be really successful. 20% would be on the high side in the portfolio. Usually it's around 10%, and those companies will be the ones that are generating a bulk of the returns. And then 30 to 50% might be okay. We'll refer to these as soft landings, right? They're returning capitals or 2, 3, or even 5 times, but typically venture investors will be looking for a much higher rate of return than that. And the rest of the portfolio will be complete washout, and that's to be expected. If our success rates were higher, it probably means we're not taking big enough risks.
Mm-hmm. I've got a question for you. How did you become a VC?
Good question. By serendipity. And as after I entered the industry, as I talked to more people in the industry, it turns out that most people enter the industry by serendipity. So in my case, I had worked 15 years in the enterprise IT space, 3 startups, mostly in engineering and product management. And after the last company got acquired, I decided to take a break, went to Stanford Business School, got my master's. And at the business school, I ran into one of my current partners, Rob Siegel, who teaches at the business school. I sat in on some of his classes. Originally, my goal was to start a company out of school. But after experimenting with 4 different ideas, I didn't like any of them enough to go build a company around. So pivoted my direction to looking for product leadership roles in startups. And as part of that process, spoke with a number of venture firms, reconnected with Rob after graduation. And he said, well, why don't you hang out at XSeed and see if you like it?
Right. Great. We have another question. And how do you differentiate your VC firm with other VCs? How do you support entrepreneurs?
Great question. Certainly a lot of options to choose from these days, a lot of sources for seed capital. Where we differentiate ourselves is when we are very engaged with our entrepreneurs, because seed stage investing is our business. We have intentionally built a team from people who have strong operating experience so that we could at least share with our entrepreneurs the mistakes that we had made in the past, the lessons we had learned, so that our entrepreneurs don't need to repeat the same mistakes. Building a company is hard enough. You don't want to make the easy things hard, right? And we have also built an extended team of entrepreneurs in residence or executives in residence who are repeat entrepreneurs or seasoned executives from different functions and different industries who are ready to help our entrepreneurs. That's fairly different than how a lot of venture firms work with their EIRs. Our EIRs are very engaged with our portfolio companies. And then thirdly, we also have what we call an XSeed fellowship program, where we bring in current PhD students from top universities like Stanford and Berkeley, who have domain expertise in areas that are in high demand for a lot of technology startups, such as machine learning, natural language processing, and user psychology. And they are ready to help our portfolio companies as well.
You know, we have a lot of international students and viewers and that sort of thing. And you're in Silicon Valley. I know that there's a tendency for Silicon Valley VC firms to invest in things in the Valley. You know, do you go outside the sandbox, so to speak, to make investments, or what would make you invest in something, you know, in a different geographic location and perhaps even overseas?
Yeah, we primarily invest in companies in the Western United States. Most of our investments are indeed in the Valley or in the Bay Area. We do have one investment that is based in Israel, a very compelling team and compelling product and opportunity. And when they came to us, they were ready to expand to the US market. What it comes down to is we want to be helpful to our entrepreneurs. We don't want to be just a supplier of capital, because capital is simply a commodity. For us to be helpful, and especially in the early stage of a company, and if we're to be highly engaged with our entrepreneurs, we need to be able to see them, meet with them, interact with them on a regular basis, which is much harder to do if they're international and located outside of the US. In the case of our Israeli portfolio company, they do come to the US fairly often as they are expanding to the US market. So that helps.
Okay. Going back to some of the terms in the term sheet and you were talking about boards, you know, control is basically all about, you know, the board and how they set up the boards and all that. What do you think about an entrepreneur should do in regards to a board to set up the company for success?
Good question. A common setup that we have seen at the seed stage is a board that consists of 3 members. One is typically the founder and CEO. Second one would be the lead investor of the seed round. And the third one would be an independent value-added board member, mutually agreeable to the other 2 board members. And I would strongly encourage entrepreneurs to keep the board tight and small, because as you raise additional rounds of capital, you will be bringing on additional board members. And getting existing board members to step down from a board is a high-friction exercise. So if we start off with a relatively large board, let's say 5 people or even 7 people, heaven forbid, at the seed stage, it's just going to make your subsequent rounds more difficult. Fundraising is hard to begin with, so try to eliminate friction as much as possible.
Yeah, around that, what are the biggest mistakes that entrepreneurs maybe commonly make when they're establishing, maybe it's even with just the board of 3?
Common mistake would be one, not having a board. Actually, I'm seeing a lot of entrepreneurs who don't want to have a board for as long as possible. And based on what we have seen, it is actually much better to have a board established as early as possible. It instills discipline in the management team to have to report out to an external body once a month or once every 2 months on how the business is performing. It also provides an avenue for your committed investors to be helpful and help you think through the strategic issues and help elevate your mindset from the day-to-day tactical items that you engage in. Because naturally, when you're building a company at this early stage, you're a very small team. You are probably the chief, you're CEO and about chief bottle washer. It's very easy to get mirrored in operational details, and you need to be heavily involved in the details. But it's also critically important to elevate yourself regularly to think about, am I going in the right direction? Am I even in the right forest? So having a board is very helpful to help you think through those issues. And when it comes to composition of the board, one very common request I've seen from entrepreneurs is to have, let's say there are 2 co-founders. They want to have both co-founders on the board. They've been doing things equally, splitting everything equally, 2 of the same mind. They want to keep it that way. The thing is, at some point in time, you have one of them needs to step down from the board, and it's the CEO that stays on, right? And you might as well have that conversation early on. You should really think about what's best for the company. If I have 3 seats, do I want to really take up those 2 seats with both co-founders, or do I want to make one of those seats available for, let's say, someone who's really experienced in the industry, an experienced CEO who could be an excellent coach to a first-time CEO, and bring that person onto the board? Or is it better to just have my co-founder take up that seat? You got to think through what's best for the business, what's best for the company.
Do entrepreneurs need to be prepared to give up a seat on the board to the VC firm that's giving them money, or do you take a board seat usually, your firm, or do you do that at the next stage?
We typically take a board seat. Our initial investment usually ranges between $500,000 to, say, around $1.5 million, which is a pretty large check for the seed stage, because these rounds usually are between 1 to 2 or maybe $2.5 million. So we often end up being the largest investor in the round. And so in order to protect our interest, we would like to have a board seat. And that's fairly common when you're raising seed capital from an institution.
When entrepreneurs are negotiating with the VC firm, do they really have any control around the terms of the sheet, or are you guys really calling all the shots? I mean, what do they really sort of have control over being able to establish?
The lead investor will be the one putting down the term sheet. You would want the firm to be proposing the terms, not the other way around. Now, you do have negotiation leverage on many of the terms. How much leverage you have is a function of how many competing term sheets you can get, and that's a bit of a dance. You want your options to arrive at your table at roughly the same time. And the way we do it is, when we issue a term sheet, usually it expires in a week. It gives people enough time to digest the content, have a back and forth, without having it being a drawn-out process. And we want to give the entrepreneurs enough time to make sure they are signing on to the terms that they're comfortable with, that they understand what they're signing up to. But at the same time, don't want that process to be so long that the deal is being shopped around. No investor would like the term sheet to be shopped around and be a stalking horse for generating just a higher offer. So usually a week, or maybe slightly more than that, if we really needed the time, is all we need to come to terms.
Along that line, how do you feel about entrepreneurs and the getting multiple term sheets?
Sorry, could you repeat the question?
How do you feel about when the entrepreneurs are trying to get multiple term sheets to see if they can get the best deal?
It's to be expected that the entrepreneurs would be speaking with multiple venture firms. They should be. If they're not, then we actually would question how well they would be how good a job they will be at building their business. So we won't be offended if there are multiple offers on the table. What we don't like to see is they getting a term sheet and then showing it around to other venture firms. That would be a big no-no. Right? What you want to do is pitch to all the right venture firms that you want to get on, the right potential investors for you, get the best offers you can get from them individually without revealing the contents of the competing term sheets. You can verbally give these potential investors a sense of the range of offers that you're receiving, but you need to be honest about that. Don't make numbers up because it's a small ecosystem.
Yeah, I was going to say it's a small ecosystem. People do talk to one another, right? I would encourage people. We've got like 5 minutes left with Alan Chiu from XSeed Capital for any questions you have around venture capital or term sheets or anything like that. I have heard from investors that often their biggest complaint is that entrepreneurs can be very naive around the term sheet. What do you think causes sometimes perhaps the most misunderstanding about when you get into negotiations that the entrepreneur really doesn't understand about the term sheet process?
I would say one of the common items that's misunderstood is around what gives them control. A lot of times entrepreneurs feel that if they have 2 board members out of a 3-member board, they have control. Almost all board issues are determined through discussions, not a formal board vote. If you had to force a vote and have the 2 co-founders outvote your lead investor, the company is probably in a really bad shape anyways. Right? So that's really not an issue that is worth fighting over. Rather than worrying too much about having control over the board, going back to my earlier point, think about what's the best composition, the best people you can bring on board to help build a successful business. So that's the common mistake number 1. Second one is getting too hung up on valuation to the point of arguing over $250,000 pre-money valuation or $500,000. In the grand scheme of things, if you're really successful, it doesn't matter. It's in the noise. If you're not successful, it also doesn't matter because only 100% of nothing is still nothing. So that don't expend too much energy on that front. What you do want to look into issues such as liquidation preference, whether it is participating versus non-participating. XSeed is very entrepreneur friendly. We do 1x liquidation preference, so it's very straightforward. But there are venture firms out there that I've heard that would still try to do more than 1x liquidation preference for entrepreneurs. These are typically firms outside of the Silicon Valley ecosystem.
Is there any, we're coming up to the end here, is there any kind of parting advice that you have for entrepreneurs who are searching for that first seed capital, some top 3 things to do? I mean, you've given so many great tips within several categories, so I'm kind of asking you an overall general question of what's, in terms of the best way to get VC's attention and get the project going towards a term sheet.
So we look at opportunities under 3 lenses or 3 areas of risk: technical risk, execution risk, and market risk. Technical risk means whether the technology works. Does the product do what it's supposed to do? Execution risk means do you have the right team to execute towards the opportunity? And market risk means are there customers at the end of the day as you expected, and are they willing to pay what you expect them to pay? Do everything you can to mitigate these 3 risks as much as possible before you pitch to a venture investor. You may try to bootstrap your way through it. You may try to raise some capital from angels first before you pitch to venture capitalists. But do everything you can to mitigate these 3 risks. And if you were to prioritize which risk you want to take on and take off the table, market risk. Focus on the market risk. If you can prove that there are customers who are dying to buy your product at the price point that you want, and there are many more of them, and you find that you have even more pricing power than you expected, then that's amazing, right? That's the kind of evidence that you want to put in front of potential investors and show them, look, we have got something compelling going on here, and we just need your capital to go turn this into a large business.
Okay, we have a couple of questions. Do you have a few more minutes, Alan?
Sure.
Okay. Once you've set the terms as lead investor, how does the process work with other investors? Do you and the entrepreneur continue to contact investors to join the round, or is the focus only on investors already on board?
Sure, there are a number of ways this could happen. So first principle is the entrepreneur always decides who he or she wants to take on as an investor. The lead investor would never, like a good one anyway, should never force an investor onto the company. Sometimes when we decide to make an investment, the entrepreneur has already lined up a number of other investors who are also serious. They might be angel investors or other seed venture firms, and we'll try to work with them to put a round together that meets everybody's needs and interests. Other times we might jump in before there are other serious interests, and in that case we'll work with the entrepreneur to figure out, okay, who else do we want to bring on, who are the value-added investors that will be really helpful to the company, and we'll tap into our network. We'll also the entrepreneurs, of course, will tap into their networks as well to make that happen. We often syndicate. It's a good thing for the entrepreneur, for the company, to have more than one wallet around the table.
And another question is, how do you feel about solo founders or multiple founders a must?
A strong preference for multiple founders, and here's why. It's not because the solo founders can't build a successful business, but we're looking for proof that you could sell your vision to at least one other person, right, who is willing to commit as much as you do to building this business. And if you're a solo founder, that evidence is lacking, which means the bar for the other evidence that you need to provide will be subsequently higher.
Okay, great. Well, thank you so much for joining us, Alan Chiu from XSeed Capital. This has been a great hangout, lots of practical advice. So even for folks who didn't get a chance to watch it live, hopefully they'll see it later. So once again, thank you for joining us, Alan.
My pleasure, and all the best.